First, we'll keep with tradition and show you how Berkshire is developing. Berkshire, of course, has an impeccable business model and exemplary management teams throughout the entire organization. And in 2019, I disclosed our expected market cap in 2030 of 1.7 trillion. And some very intelligent people pushed back early on, questioning, how can I expect Berkshire to become the largest company in the world, et cetera, et cetera? Well, it didn't actually have to be the largest company in the world. We now see many companies have surpassed the $1 trillion mark. Apple alone is already worth 2.5 trillion today. Berkshire shares are up about 40% in the last year, yet our models show it still has 35% upside to the true value today. So it is essential that you understand also that Warren Buffett is currently buying back tens of billions of their stock each year because of these share buybacks, the stock can actually perform better than market cap growth because there will be fewer shares owning the business in 2030. So this is a vast oversimplification, but basically in 2021 value column, you can see that as of last week, they have 144 billion in cash, they have 308 billion in equity, and the value of their operating businesses is 450 billion. So this suggests a 900 billion value today, which is a 35% upside from today's prices, and it is growing. And that is why Buffett is spending tens of billions each year buying back his own company stock. But of course, that's not all. We're going to keep coming back to these examples. We don't pay NYSE prices for our shares. We don't buy like a retail investor would buy, and we are getting paid premiums all along the way as we hold these shares when shares dip in the market. So again, similar to the previous example with the $100 stock, we use structured products as a tool to own the equity. And just last year, this is a real example, we were paid $18 to purchase shares for $165 over a 6-month period. This was an extraordinary price, and we picked up a 25% annualized IRR on our collateral during this opportunity without even owning the stock. We just committed to buy more if it went down. And so this is just totally remarkable that we're able to pick up this level of IRR on a company that would be as undervalued and as strong as Berkshire Hathaway.
So let's talk about one more company, the company, Berkshire Hathaway. So this questioner is asking how you see Berkshire growing and being priced in the future. He's asking what the assumed growth rate you consider to be reasonable for Berkshire. At 6% growth, it seems to be fully priced. If you assume 10% growth, perhaps it could be going much larger. Do you tend to use conservative growth rates or larger expected growth rates generally when looking at companies, and then specifically at Berkshire?
Yeah, I think we use, we are typically very conservative in our calculations. So what I'm looking for is for us to be surprised at the upside. And so if I think about, the slide that I was referring to, I think we have a very reasonable, but I think we have a very reasonable growth rate. I think we use a 10% growth rate on the operating earnings of Berkshire. And the surprising thing is that many people, so the surprising thing for me is that I think many people put Berkshire in this category where they just think it's going to stop growing. I get pushback all the time on Berkshire. And it's, they have like 144 billion in cash that they're probably going to put to work at some point in, say, the next half decade. They may just go and buy like $8 billion in operating earnings. And I could see a scenario where, operating earnings jump to like $50 billion. And, at a very conservative level, that would suddenly be like maybe a $750 billion valuation. And that's just putting their current cash to work. I mean, they're basically making, about 25 to 30 billion a year now in their operating earnings. And I expect that to grow quite a bit. So we do use conservative estimates. We use about 10% growth on Berkshire. I think, Buffett's been growing the business at about 19% for almost 60 years. And the last 10 years, it's come down to like 10 or 11%. People often worry about his age. I think if you really understand the company well, you see that he has all the lieutenants in place to take over. And in fact, Buffett himself has said that he expects the share price to go up, not go down after he dies. So, and the reason being that there will be all sorts of speculation on breaking up the company. There will be speculation on paying out dividends. There's going to be all sorts of interesting things that happen. And so Buffett has said that he expects it to go up. And I'll also add, I don't know if I see it down there. I'm not going to get it, but I also will point out on that, to that point, I have this actuarial table behind me. And basically, if you're a healthy 90-year-old, which Buffett seems to be, your life expectancy is 6 years. And if you're a 96-year-old and healthy, your life expectancy is like 4 years. So it's sort of strange to if you're interested in a company like Berkshire, don't try to time it and wait for Buffett to die and there to be a dip. He might be around for a long time. And I think the company will compound quite well. It will outperform the S&P 500. We're able to buy it through structured value. It's a stabilizer in our portfolio. And it basically, in a way, it's a really contrarian play, because when the tide goes out, when there's a crisis, Buffett's standing there with cash waiting to pick up all of these really cheap securities. And so I think it's a really great position to hold in a long-term value fund.